On this channel, I've discussed a lot of investing options that are suitable for long-term goals. These options are usually funds containing stocks and have rewarded regular and patient investors with great returns, albeit with volatility along the way. And that is all well and good, but what about the cash that we need to park somewhere safe without volatility? Or for cash that we want to earn some sort of return on, but will need it for a short-term goal and can't afford to risk a crash or dip in the stock market just before we need it? Well, in this video, I'll discuss exactly that. I'll look at one of the best types of fund to park cash in the UK with low risk in 2024. The best part is that parking cash has not been this exciting in a long time. I'll explain what I mean by that. Unlike the past decade or so, we now have an unusual situation in the UK where we can beat inflation whilst taking almost no risk. And this is because the Bank of England base rate stands at 5.25% after a number of increases throughout 2022 and 2023 to combat inflation. Although not always the case, as it depends on a number of things, the central bank rate gives you some idea of the sort of return you can expect from parking cash in the correct places. And with the latest inflation figures, measured by the Consumer Prices Index coming in at 2% for the 12 months to May 2024, that means the real interest rate is 3.25%. That's not too bad at all if we can obtain it. To put into perspective how unusual that is, take a look at this chart. It shows that apart from a brief time in 2015, real UK interest rates have been negative for more than a decade. That means that people obtaining the central bank rate or something similar on their cash have actually lost money in real terms. In this sense, parking cash has offered no reward and you've just had to accept some sort of decay in value as the price of taking no risk. So whilst we are in an unusual situation where real interest rates are positive now, the problem is that most banks are not passing on this rate to their customers, and in some cases they're taking the mick. For example, NatWest are currently only offering an interest rate of 1.75% on their flexible saver account for balances up to £25,000. I hate to think how many people are being ripped off and using this account. However, as I'll show in this video, there's no need to get ripped off by a bank, and through using something called a money market fund, it's possible to always obtain a rate of return on your cash close to whatever the Bank of England rate is. Before I begin, always remember that my videos are not financial advice or a recommendation to invest in any featured fund. Whilst this type of fund featured in this video is very low risk, it is not 100% risk free, and it may well not be right for you. Please do your own research and seek financial advice if needed. So, what is a money market fund? Over the past year, much more attention has been paid to this type of fund, and that is for a very good reason. At times of high interest rates, they are very attractive places to park your cash. If you've not heard of them before, then I don't blame you. Up until recently, no one had been talking about them for a very long time. And that is because, for the previous decade, interest rates have been so low that no one should have really been using this type of fund anyway, in my opinion. A combination of low interest rates and fees has even seen some of these funds have years when they've lost money. However, with rates being held at 5.25%, money market funds are now incredibly attractive. This is because they tend to provide a return close to the base rate of the central bank of the currency they hold. For money market funds denominated in pounds sterling, this will be the rate set by the Bank of England. The funds deliver these returns by investing in short-term debt. This could be debt from governments, banks, or companies, but all with high credit ratings. The short-term nature of the holdings means that money market funds quickly adjust to any changes to the central bank rate. As the short-term debt holdings in the fund mature, they're quickly replaced by debt issued at the new rate, which means your money invested in the fund will quickly adjust to any increases or decreases in the bank rate. The combination of the debt being short-term and of high credit quality means that these funds are very low risk. There is very little chance that a highly creditworthy source will default on their short-term debt. If you look at the key information document of any money market fund, you should see that they have a risk rating of 1, which is the lowest risk rating a fund can be given. As a UK investor, I would only put my money in a sterling money market fund. Although money market funds in different currencies are available to UK investors, we have to take into account any currency conversion fees as well as the additional currency risk that comes from investing in them. If you have money in a USD money market fund, for example, but the pound strengthens against the dollar, you may get a lower return than the central bank rate. Looking at a performance chart of the Lixor Fed Fund's USD cash ETF provides a perfect example of this. As UK investors, we purchase this fund on the LSE and our pounds will be converted into dollars in the fund. However, when we come to sell our holding, the dollars will have to be converted back into pounds. Therefore, you can see the return of the fund fluctuates in line with the exchange rate, GBP to USD. When the pound strengthens, the return of the fund decreases. You can see the almost mirror effect in the relationship. You can avoid this by investing in a sterling fund, and the currency risk will be taken out of the equation. A good way of seeing what to expect from a sterling money market fund is to look at the SONIA rate, as all funds I have seen have this as their performance benchmark. SONIA stands for Sterling Overnight Index Average. It is based on the actual transactions and reflects the average of the interest rates that banks pay to borrow sterling overnight from each other. It's published daily by the Bank of England, and you can access all the historical data on the Bank of England website. You can see on the chart how the SONIA rate has increased in line with all the base rate rises. At the time of recording, the SONIA rate is 5.2% and has been since around August 2023. This gives you a rough idea of what sterling money market funds will return. However, as I will show, some money market funds have actually beaten this benchmark. One example of a fund you can invest in directly is the one offered by Royal London. This is available in both accumulation and income units. The fund's performance target is to outperform, after the deduction of charges, the Bank of England SONIA rate over rolling 12-month periods. It has a risk rating of 1 and has a pretty low fund management fee of 0.1%. On the second page of the fact sheet, looking at the sector breakdown, we can see that the fund is made up of covered bonds, gilts, and money market instruments. The top 10 holdings include UK government bonds and debt issued by big banks that you'll recognise. I hope this breakdown gives you a better idea of how low risk these funds really are. I personally can't see much chance of the UK government or these banks defaulting on their short-term debt anytime soon. Going back to the performance chart on the first page, we can see that the curve got steeper and steeper as interest rates increased. The flat part is from when interest rates were almost zero, so of course the fund delivered pretty much no returns. And the cumulative performance table above shows the fund has outperformed SONIA, with the 1-year return equaling 5.3%. It's worth noting that this fact sheet is from April 2024, so the 1-year return will include some months when interest rates were not yet 5.25%. And by looking at the 6 months return of 2.7% instead, if we double that, it does seem to be offering an annual rate of return of around 5.4% at the moment, which is very impressive. So that's one example, but money market funds can also come in the form of an ETF. A couple examples of these include Lixor Smart Cash and Xtrackers GBP Overnight Rate Swap. CSH2 is an accumulation fund, whereas XSTR is a distribution fund. You can ignore the yield for XSTR, as it will be trailing and most likely includes some distributions before rates were 5.25%. All money market funds work slightly differently, so it is worth reading into them before making any decision. For example, CSH2 does not actually physically purchase short-term debt and actually generates a return for a swap agreement with SocGen. In that sense, it's a synthetic money market fund. Looking at the performance of CSH2, what I like most about it is that you can see the historical monthly returns. You can see how in the last decade or so, the returns have been pretty terrible, and this is in line with how low interest rates have been. Whereas from 2022 onwards, you can see that when interest rates were starting to pick up, the returns started to increase as well. The most recent data shows that the monthly return for May 2024 was 0.48%. Before you decide to utilise a money market fund, here's a few pros and cons to consider. The biggest pro of them is that you're able to beat the return of pretty much all easy access savings accounts on the market, whilst only taking on minimal risk. Another pro is that if you have a very low risk tolerance but want to invest, money market funds are about as low risk as an investment can get. And they are very predictable, unlike stocks. You can never know for sure which way a stock will go, but with money market funds, you can just look at the base rate of the central bank to get a pretty good idea of the return you're going to get by investing in it. Another great advantage is that you do not have to constantly shop around for the best savings account and move your money around. With money market funds, the fund will quickly adjust to any increases or decreases in the Bank of England base rate as it buys short-term debt at the new rate. And finally, money market funds can be held in a stocks and shares ISA, SIP, or lifetime ISA. So there are many ways to keep your money market fund returns shielded from tax. Moving on to the cons though, the biggest strength of money market funds is also their biggest weakness. They quickly adjust to any changes to the base rate, so if the Bank of England rate decreases, then so will the returns of the money market fund. Also, it's worth remembering that low risk does not equal zero risk. They don't have FSCS protection as they're investments and not cash. You also need to consider that if you're holding one in a general investment account, then taxes may apply. Not all money market funds are taxed the same though, so make sure you look into that. If possible, it's always best to hold a money market fund in a tax-free account like an ISA to avoid any tax headaches later down the line. And finally, money market funds should not be considered a substitute for long-term investing in stocks. The data strongly supports that for long-term horizons, you'd be much better off putting your money into equities. Any person who's kept all their money in a money market fund over the past year will certainly be kicking themselves, as they pretty much saw all those great returns in the stock market pass them by. So, that was an overview of money market funds. I personally think, at times of high interest rates and now finally low inflation at 2%, They're a great way of getting an almost risk-free, real rate of return on your cash. However, if you're not convinced by them, there are of course many other options for short-term goals, such as premium bonds, a standard savings account, or even individual gilts with short maturities. They're all worth checking out. If you enjoyed this video though, please consider leaving a like, and I'll see you in the next one. As always, thank you for watching.